Good evening and welcome to the FiTT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I'm Thomas Doty.
And yes, we are the FiTT Show helping out people get their finances in shape. So we're so glad you're joining us today, which is October the 16th. This is our 217th show. We're so happy that you join us and looking forward to another great show. Last week, our show was Wealthy People's 5 Core Wealth Principles. We hope those were useful to you and hope everything was good on that as far as providing information. Just want to cover a few things with you, a few technical uh, uh, things. So we are not financial fiduciary. We have no financial fiduciary responsibility. We're not financial advisors certified. So we just want you to know that take this information with a grain of salt. I mean, it's supposed to be applied generally because everybody's individual situation is unique to them. So we just want to make sure that we're not trying to provide pure financial advice for your specific example. But I guarantee you, the stuff we use, we tell you, you can definitely apply it to your life in general. But if you want more specific pertaining to your personal investment portfolio, please seek advice from a certified financial advisor or certified financial planner, and that would be good. Just want to get that. Also, please um, click on the like button as many times you can because that actually helps us with reaching out to people. That's very important. Uh, it's been great 217 shows. We've haven't duplicated a show. We might have duplicated some comments within the show, within each show, but each topic has been different. So we are always open to new to new newer topics. Also, how this works, putting comments in the comment box really helps considerably because the algorithms are driven through that even more so than clicking on the like button and the heart button. So, any comments you put in there, and please, if you got opinion on something we're saying, or you have a question you want to ask us, we're going to try to cover it if it's in the flow. If it's something totally outside of what we're talking about, we can get back to you the next show. But more likely, we'll cover it. So we try to make this open, and we try to make since we're in a virtual studio, we try to make the interaction that we can have is through the comment box. So please don't hesitate to use the comment box. With that, Thomas Doty, how are you doing today, sir?
Bittersweet today, man. This is the 8th anniversary of our dear friend's Kevin Cato's death, who was
Dope, that's so right. I'm totally wow.
dear to both of us, and sad because he was such a good friend and such a wonderful person. But kind of looking back on all the good memories we had with that guy and all the happiness he brought to me and my family, and just a wonderful dude. So happy and sad at the same time.
Yes, Dope, I'm glad. That's right. The day was the 16th, sure enough, 2017, if I'm correct. And Dope, Kevin, for some of y'all didn't know, Kevin Cato was our teammate at Penn State University. He was first Dote's roommate, and then Dote graduated. He became my roommate, and then he actually became my assistant coach when I transferred from Penn State to Texas A&I University. And then when I went overseas to play professional basketball in Scotland, my 2 years, last 2 years, he was my head coach. And he went on to be, actually, he's in the Guinness Book of World Records in Great Britain for the most basketball trophies won.
Championships, yeah.
Championships, yeah, yep, most championships. And he had a stellar television career. He became an in studio personality for, believe it or not, in the NFL.
Well, he was influential in bringing the NFL to London. So those
Yes.
games you see on Sunday morning out of London, Kevin was involved in making that happen.
Yeah, yeah. He started off doing the NBA, believe it or not. Then they lost that contract Sky Sports News.
Mhm.
Go out, check out Sky Sports, some archives back in like the late mid '80s all the way through the '90s. Kevin did great stuff over there. So, great brother, may he rest in peace, man. And we had some great, oh boy, me and Kevin while we were over in Amsterdam and Portugal and France. We've had some great times.
We did at Penn State too. We
Especially, oh.
had
That's
some.
funny. People say, why are we laughing so? Because we had such a good time and such a good brother. All right, so let's get on with this show. Dope, look, man, let me tell you, Dope. You have been, it's like you're a prophet. You've become like a swami. 'Cause
Yeah. I don't know where you're going with this, but
No, but you've been saying, man, Bob, I don't know about this market, man, and all the uncertain times. There's so much craziness. It seems like this can't hold up. This market might crash at some time. And not saying that it crashed, but today, I don't know. Let's get into it, though.
that's how I feel.
How was today? Let's
Today,
start with that.
this past week has been terrible.
Yes.
Yeah, you have the chart. You want to put it up?
Yeah. Hopefully it works. You know how it goes.
Don't say it. Don't jinx it. It's gonna work.
There you go.
You've been pretty consistent.
Did it come up?
You certainly did.
Oh, there we on. We're on. Okay.
Yeah, it's been a tough week in the market. Not overly bad. It had a real bad day Friday. Came back a little bit Monday, early this week, and it was because the president made a comment about the China tariffs, and that's still weighing on the market. And also, the market took a big hit today, and that was related to the banking system. And several regional banks had a couple different issues. One had some loan losses, another had a fraud situation, and they're thinking that might be symptomatic of issues in the market with the bad loans, or people overextended, and so the market took a little hit today. So as you can see, S&P is down 1.6% for the week. Nasdaq's down 2%, and a lot of the stocks I hold had a tough week. Microsoft's down same 2% as the market, 512, down 10 points. Apple's down 7, Nvidia's down 11. Google continues to roll. It's up 10 points. It had a banner week. Pfizer's down 1, Palantir's down 7, and United Healthcare is down 12. And as we're going to talk about today, as Bob was saying, I was telling him how uneasy I am in this market because several companies' earnings have continued to be good, but there's just so many headwinds. People seem to be ignoring the fact that all these tariffs are going to create inflation. There's no way around it. When you look at how much money the tariffs are creating, it's actually created enough money. It's keeping the deficit down. That's how much money's been raised by the tariffs, and that money has to come from every couple different places. Either it's coming from the people who shipping stuff in, or it's coming from the people who buying it, which is us. And when it comes from us, it creates inflation. So I think that's going to be an issue, and I think that's going to cause the Fed some concern when it's time to cut interest rates, because they will not cut interest rates if there's a threat of inflation. And so I just think that's that backdrop between that. And if you just look to the far right at how some of these stocks have done year to date, Microsoft's up 22%. And realize we're only let's say 9 months through the year. Nvidia's up 36%, Google's up 33%, Palantir's up 134%, and you have a lot of overvalued stocks in the market. So I am as uncomfortable as I have been in a long time. I just think there's just so many things going on that are negative. So I hope this isn't the beginning of the downfall, but I am not comfortable with the market. And I say all that to say, it's not like I'm going to go out and sell everything, because most of my stocks are at extremely high when you compare it to what I bought them at. And so I'm sitting on a bunch of capital gains, but that's not how I handle my finances. I pick good stocks and I stick with them until I feel they aren't good stocks anymore. So none of the stocks I own I feel are not worthy of me keeping them. So I'm not going to make any changes. But I'm very nervous right now.
So, Dope,
Yes, sir.
I want to give you a little backdrop when you talked about some of the things that might have caused the market with banks. And a lot of my friends, because I worked at the FDIC for 30 years, and I used to close banks, worked at the Federal Savings and Loan Insurance Corporation too in the early 80s. And so a lot of people call me worried when they hear about bank information like you talked about today. And I try to inform them. It's so interesting though. So in 2008, the economic downturn, right?
Mm-hmm.
There was 25 banks that fell. And then the next year in 2009, there was 140 banks that fell. Now, Dope, when I was at the Federal Savings and Loan Insurance Corporation in 1988, 700 savings and loans fell, and we still made it. And now I'm telling you, in 2009, 140. But guess how many banks have closed to date? 2025, only two. Last year, only two banks. 2023, though, only five banks. 2023, 2022, no banks. 2021, zero banks. So, and I just want to let people know who are panicking about the banks and their money. The main thing is you got to make sure that wherever your money is in a bank that has the four letters in the window saying FDIC insured, and not one insured deposit has lost a penny since 1933. So I just want to let people feel assured that the banking industry is up and pretty strong right now. So,
Hey, Bob, remind them of the limits on that.
okay, so back in back in the 80s, it was up to $100,000 per category accounts. In 2000, they raised it to $250,000. That's per categories of account. So people think this is one time you have 250,000, but actually you get a individual account, meaning in your name, for $250,000, and your wife can have an individual account in her name for $250,000, and then you can have a joint account in you and your wife's name. So that's another 200. So that's 750,000 right there that you can have insured in one bank. And then you can have as many what they call in trust for. If many kids you can have, you can have account another 250,000 for each kid in trust for. So if you have four kids, you can have $1 million insured. And they don't own the account; they just in trust for. If you pass, it goes to them, but you own the account. So that's a million if you got four kids. And if it's you and your wife, that's another 700. So like about $1.7 million you can have insured if you structure your accounts accordingly.
And Bob, one more thing. You know how anal I am. And so if you don't put 250 in there if you're drawing interest, because with the interest, you'll end up over 250. So you'd only want to put 230, 240. And so if you are getting interest on those accounts, you don't want to have over 250 in that account because only 250 is covered. Okay?
Very good point, though. Very good point. I'm glad you brought that up. But that's how it works. A lot of people just think it's 250,000, but it's per category of accounts that you can get up to insure. And just want to let you know, the banking industry right now is pretty strong, but like we know, all things can change. Let's talk about the crypto. Well, Dope.
Yes,
Gold was up like something like $100 and something today.
gold is rolling, man.
So for all those people who took our hunch and got into gold, that was a good move. Let's talk about cryptocurrency. Cryptocurrency is taking a beating. Uh, the Bitcoin from last week has dropped down to 13. It lost $13,650, down 11%. It was 121,000 per Bitcoin, but now it's at 107,000 per Bitcoin. That's a major drop. And it seems like all the other coins have dropped to like 11%. Ethereum, Binance. Tether is still holding the stable coin. Ripple is down 18% in Solana. So, like we say, very highly speculative, and you can see the swings from week to week. But just remember, it's all about the long play. So, Dope, with that, let's get into talking about our topic today. And our topic today is coping with volatile times.
Yeah, and we are definitely in volatile times. We've kind of been on this long bull run. And in 2025, we got a crosswinds, as I mentioned earlier. The economy's still growing, but tariff policies, nobody's really getting their arms around that. That's totally unsettled, especially with China. I mean, nothing's really etched in stone there, and you have two very stubborn countries involved in that. You have our country, and China's thinking if the market takes a big hit, that the U.S. will cave, and so they think they have the upper hand, and of course the U.S. thinks they have the upper hand. And so you have two very stubborn combatants, and this thing could turn very, very ugly. They're the two biggest markets in the world, and no telling how this is going to shake out. And we haven't even mentioned the shutdown, and that could go on forever. You also have job reports that have been coming in kind of shaky, a lot of unemployment there, which implies weakness in the economy. But at the same time, you have these tariffs that are creating inflation. So everything's still looking like the economy is continuing to expand, and we're not seeing recession right around the corner. The GDP is continuing to grow, and corporations are still reporting very good earnings. And so, but you look at other things like unemployment, you look at manufacturing, consumer confidence, this thing with the banks and how much they're overextended. And there's potential for more things to blow up as we look ahead. So as an investor, you got to prepare yourself for the possibility that uncertainty may wreak havoc on the market. So if you look at our stock valuations, as I mentioned when we were looking at the market update, everything is at historical highs. So market values are very, very high right now. And that could make the market more susceptible to wobbles, meaning continued uncertainty, which could create a whole lot of volatility.
I had a quick question for about the banking. Mo Better, who's on early today, glad you're on early, Mo Better. She said, I have a question here. We doing it wrong by putting our name on the bank account. No. It's cool to have your name on the bank account because, like I said, you get an individual account with your name. But if you want more insurance, you can put it in trust for or payable. It's called payable POD, payable upon death. That also can insure it. No, that I'm sorry. That only determines who, if you die, gets it. Because you can have 3 individual accounts that are payable upon death, but it has to be trust account. Just want to add that for you, Mo Better. Dope. Excuse me. Much of the 2025 has been a volatile markets, and it can be unsettling for many, people. Who might be wondering whether it's time to cut out and take your money and run, or even just basically overhaul your investment strategy. But behavioral research has shown when stocks are soaring, we instinctively want to buy. never mind how expensive the shares have become. And then when prices are plummeting, we get nervous and want to sell and lock in the losses. All this is the exact opposite of what we may need to do to be successful. But human nature, is our foe. Isn't our really foe. It's not our really. Human nature drives us to do a lot of things. But just wanted people to know that the Standard and Poor's 500 index since 1950 to 2024 have logged 11 bear markets. And a bear market, I think, is 4 quarters of going down. That's only 11. While several bear markets lasted well over a year, others hung around for fewer months. So even in April of 2025, we experienced a 3-day bear market and reacted to the new tariff policies, right? However, the index also set several record highs. So what's more, the bull markets that follow bear markets tended to last on an average much longer. So for investors, for most investors, the smartest moves might be right now to not abandon your plan, for sure, and instead stay invested and rely on a broad diversification to help to weather in these crazy storms of volatility. And that's what we're going to talk about today, coping with volatile times.
Let's start with a quick review of this year. You remember what happened in the second quarter? It was a sharp sell-off when they first announced these crazy tariffs. And the stock market dropped about 19%. And that caught a lot of people off guard. And we always say that 20% is the bear market threshold. So it was slightly under that. But that proved to be short-lived. So they start pushing off the tariffs. There was pauses. There was, okay, we'll continue to talk. We're going to keep negotiating. So before the second quarter was over, the S&P had made up all that money it had lost in that big sellout. And so for the average investor, that kind of thing is expected. You're going to have big ups and downs in the market. And the key is not to panic. Don't overreact. And don't get too worried because these things happen. But with these tariffs, so much was unknown. Nobody knows how this is going to work. All we have as far as history is that every time big tariffs were implemented, the market crashed. That's the only thing we know about tariffs. And I'm not sure that's not what's going to happen again. But since those in April, investors have kind of just said, we're going to ignore all that stuff about tariffs. They haven't really paid much attention to it. And so this sharp recovery is taking place and everybody's kind of ignoring it. They actually came out with the taco term, which is, they kept saying Trump was...
always cops out.
Yeah, that's what taco stood for. Trump always cops out. So the market is really ignoring that, but I'm looking at it, the effects of that are going to show. And we probably missing some information because of the government shutdown. But I think that's going to rear its ugly head at some point. And we're going to see inflation is not going away.
Now, reason why we talk about the stock market so much, because it's one of the main places that you can build wealth. And one of the things we always talked about is diversifying because, the value of staying invested and diversified is so important because this year's dramatic market turns have vividly illustrated the importance of staying invested, even when the news is changing rapidly. Investors who have bailed out when the news looked the worst might have locked in Standard & Poor's 500, 19% peak trough decline if you would have, panicked around that time, right? And, investors who simply held on to their stocks would have done much better. As of September 15th, the Standard & Poor's had generated a year-to-date return of 13.5% so far in 2025. The point of, staying in and actually being diversified. Because a well-diversified, investors might have a smooth journey to some of the similar result, like a portfolio broadly diversified among U.S. stocks, international stocks, long-term bonds, short-term fixed incomes, like do annuities. They lost less than the U.S. stocks only portfolio, meaning that if you had a diversification going measured along with an individual stock, diversification always worked out. Like April, were some of the market lows, right? And let me see if I can show you some of those market lows. I had a graph that I like to show you. Let me see if I can pull it up so you can see it a lot better. Just right quick. So in April, those were some serious lows, right? And did that come up, though?
Yes, it did.
Cool. All right, just want to show you this. The green, if you can see, the top line is diversified portfolios, and the bottom straight black line is the U.S. stock market. Look at April, right in the middle of this thing. In April, just individual stocks, they dropped down. They were like a 50% loss. But look at the diversified portfolio. They lost maybe about 6.5% versus 16, almost 17. Yeah, that's about 16% with the just regular stocks. So just once again, showing you the advantage of being having your stocks diversified, because the mixed stocks and many other investments actually have shown over time that they experience less volatility. Just one more stat I want to give you all. Standard & Poor's, since 1950, this is amazing, to let you know the importance of being in the stock market and being diversified. From 1950 to 2025, the average bull market period lasted 5.6 years with a cumulative, the average bull market lasted 5.6 years, averaging a cumulative total of 185%. And check this out. The difference in a bull market with the average lasted 1.2 years with a average cumulative loss of 35%. Just wanted to use those stats to let you know. And it seems like after every bear market, the bull market has been there. So just want to give you some, stats on the importance of being diversified and being consistent in the market.
Yeah, and the crazy thing about this market, if you look back at this recovery since April, so investors are still expecting economic activity and corporate profits to continue to grow. And they see some slowing, but nobody sees anything turning negative. And so a lot of the economic indicators, you get mixed signals as to what may lie ahead. For example, the job market, they revised the numbers and you had gains in the spring and summer, but they're much lower than what was initially expected, which suggests the market is slowing. But at the same time, even the slight rise in unemployment is 4.3 to, employment rate of 4.3, but that's still low if you look at historical standards. So for every indicator that seems to be flashing yellow, that, caution, contraction in manufacturing sector or unemployment going up, there's another flashing green, such as CEO confidence is extremely high right now. So it's really confusing right now.
Yeah, that's that's true talk though. Now, a lot of people wondering, how long inflation going to last at the mark that it is now, policy, the uncertainty, is there a recession? I just hate to tell y'all, we want the resolution of these economic worries, but many are unlikely to be resolved in the next term. like Doe was saying, many of these issues may not even have an end date. And that's why it's so important, to make sure you're diversified and paying attention to your portfolio. Now, legal challenges and ongoing negotiations could keep tariff policy in flux way beyond the end of 2025. The impact inflation, consumer spending, economic growth of tariffs implemented thus far is still unfolding, not yet even fully understood. And will continue to shift policies back and forth. Yet, as recent years have shown, the U.S. economy often finds a way somehow to muddle through, and even amid the uncertainties. For instance, like the most recent recession in 2020, right during the pandemic, it lasted only 2 months as the economies, staggered and better than expected rebound in the face of extreme disruptions, with the pandemic. And that was amazing because it dropped in March of 2020 and it came back. It dropped about 40% though, and it came back in 2 months fully. So a lot of people jumped out, really locked in those losses and feel sorry for them, for doing it. And most recently, investors widely expected the Fed's aggressive interest rate hikes in 2022 and 23 to trigger recession. But instead, the economy, just was steady and continued to move on with no recession materialized in those 3 years since the start rate hikes. So, though it's so crazy these times, it's hard to predict.
That's for sure. It really is crazy. And as an investor, nobody knows what's going to happen. Nobody knows if some of these signals are going to turn bad, if we are going to go into a recession. And so smart investors have to focus on what they know and strategies that have helped manage periods of uncertainties in the past. As Bob mentioned earlier, you got to be diversified. You can't have all your eggs in one basket, because no matter what happens, it's going to affect each segment of the market differently. It's going to affect different types of investments differently. It's going to affect different parts or different countries differently. So you should be exposed across assets, across location or countries, and even across products within assets. So it's very important to be diversified. And right now, it might be a good time looking at international stocks if you think things are going to be shaky here for a while. So this might be a good time to look at that. You also got inflation hedging assets, and they may have run their course. Gold and silver being at all-time highs. Might be a good time to look at REITs, real estate. That's usually a safe place to go during inflation times, because housing values usually go up during inflationary times. Might be time to look back at those tips that we got into a couple of years ago, those treasury inflation protected securities. And those things help buffet portfolios during the April sell-off and could offer further resilience against inflation uncertainty. And so a lot of the advisors are now jumping into commodities, tips, cryptocurrencies, those other things that tend to be inflation hedges, and things that don't always move the same way stocks move. And that can help smooth out your ride. So smart investors sticking to their long-term plans that are aligned with their goals and their risk tolerance. And that's the most important thing here. If your risk tolerance is low and you don't want to deal with the uncertainty that we're expecting, then maybe you shouldn't have money invested at this time. But if you understand the concept of no risk it, no biscuit, that you want higher returns than you can get in conservative investments, then you got to expect the volatility, knowing it's going to come. It's not when it's going to come. The market is just not going to continue to go up for the rest of your life. There's going to be uncertainty. But what we've always talked about is that in every situation that has happened in the past, after a big market drop, the market always does better in the next couple of years. It recovers what it lost and then some. So you got to understand there's going to be bumps in the road, but investors who stay invested, maintain their risk level in alignment with their risk tolerance and their overall financial picture have tended to experience strong results over the long run. And Bob and I can attest to that by how our portfolios have done. And if you look back, we both been working about 40 or worked about 40 years, and you look at all the crazy things that happened in that time with the bubble in '07, the bank crisis, the wars, the this, the that. Over the long haul, our asset base has grown. And that's where you have to really stay strong and not panic. Because if you panic, you're going to lose. And you really don't lose any money until you sell. That's one thing we've always talked about. You can't get overly concerned about gains and losses on paper. Okay, you don't really sell until you lose. And even though there may be a drop off, there may be a sell off, your stock value goes down. If it's a good stock and the market does recover, that good stock is going to recover. So keep your cool, make sure you understand your risk tolerance, and stick to your long-term plan.
Mo Better says, what are some signs that we need to sell?
And that's a good question. And I thought I answered that for my own personal self. It's different for everybody. It depends on what your goals are. It depends on what type of asset you buy. If you buy a stock, and you may buy a stock with the idea of, I want to make 10% and I'm going to get out, or I want to make 20% and I'm going to get out. In my case, I look for a stock that's going to grow over the long haul, because that's how I invest. So my idea to when to sell is when I no longer think that's a good stock. I no longer think it's going to continue to grow, that it's going to continue to outperform the market. And then at that point, that's when I sell. But it depends on what your goals are before you can determine when to sell. Bob and I go through this all the time. Bob's philosophy is, if it goes up where I can pull out what I invested, I let the rest ride, and I recoup my investment. But my goal has always been, I keep a stock as long as I think it's a good stock. Because you got to ask yourself the question, if you sell, what are you going to do with your money? Okay. Right. And so if you have a good stock, it goes up like crazy and you sell it, then what do you do with the money? And so if you're going to pick another good stock, then why not keep the one you got if you think it's a very good stock? So depends on the situation.
And I do a little bit of both. Another question, Don, how do you buy gold?
A couple different ways you can buy gold. You can go to Costco and buy a bar, which a lot of people are doing, because whenever they announce that they have gold, they sell out very quickly. The way I did it, I think I told you in our Roth account, I bought a Fidelity ETF gold fund, which invests in different gold stocks, okay? And that thing has almost doubled since April. And so you can buy gold ETFs, you can buy gold mutual fund, you can buy stock in a gold mining company. And as Bob bought the actual gold, he has gold bars. And so there's a bunch of different ways you can do it. As we've always warned you, the problem with owning gold bars is when you decide to sell, you have to find a broker who wants to buy your gold, and he pretty much sets the price. So he doesn't have to give you market price. It's not really clear what the fees may be. So that's the only reason I've hesitated from buying gold. And I've decided to invest in gold ETFs or gold funds that are ETFs.
And they can be traded anytime on the market. That's the thing
Yeah.
about the gold fund. And no, I didn't buy gold bars. What
I
I
thought you
bought,
did.
no, what I bought was an ounce, but in 4 coins. So if I ever
Oh,
wanted to sell it, I wouldn't be. If I just needed $1,000, I would have to go sell the whole bar, which is
got
now $4,000. But now I got 4 quarters, 4 coins that equal an ounce, and that way, in case if I need just to break off, then we do that.
and the other issue with owning gold is the security. Right now, people probably gonna be sneaking around Bob's house trying to sell his gold coins, trying to steal his gold coins.
No, it's not in my house. It's in a safety deposit box at the bank for some of almost who might be hanging out back thinking when we leave. No, it's in a safety deposit box. Oh God. Oh, Kitty said, oh, thanks, Kitty. The 16th, right. The 16th is the 30th anniversary of the Million Man March. And I was there. That was so amazing. So that was the anniversary of the Million Man March. That was pretty good. Before I want to ask a couple of questions, you all, just to get a temperature, a measurement on how our show has been doing. This is our 217 shows, approximately 4 years. And I want you to put in the comment box, okay? I want y'all to participate on this because we want to get an idea. We have an idea because the breakdown, YouTube breaks down our audience, the percentages. Majority over 50 something percent is over 55, but we got all ages on here. And just want to know and put in the information box. For most of y'all who've been on here, or even if you just got on, do you feel our topics and when we discuss, have they been very difficult for you to follow, or have they been just right? Just put it in the box. Do you feel the level that we speak on these topics, do you feel they have been a little bit more going over your head? Or do you feel they've been just right? Or if you feel they've been too elementary, just put in the box your comment on the level of our presentations. Just just curious on that. If anybody wants to put in the box, and especially some of y'all been on here a long time, so please put in the box. And okay, Modestine says right on point. Okay, that's good to know. Mo better, just right, but I'm still learning. Love that. Joanne, very informative. Great, good stuff. There's more people out there now. Come on, y'all, put some stuff in the box and give me some feedback. And just want some feedback because we know we got very diverse. And the difficult part for me and Dope is to try to reach everybody where they are. Kitty said 27 show, job well done, and the topics are very timely, much needed every week. All right, Carl, my little brother, okay, on point, but he says he's still learning. Okay, that's good. So that's good to know. So next, anybody else want to chime in? Because this kind of helps us. We can think we doing a good job, but it's you all that need to tell us. Okay, here we go. The show was helpful and informative, and keep on going. Great to hear. Garnett. Okay, perfect level. I have learned a lot. Oh man. Okay, great comments, y'all. Thank y'all. Thank you. Just one last question. What are some topics that? Okay, Rodney, thank you. Rodney said very relevant. So I think we've been doing a good job, man. Nobody said y'all are rubbish. So that's my British that comes out every now and then. Last question, you all. Just last question. What are some topics that you would like for us to cover? Even if we've done them before, do you want us to revisit them? Or are there any new topics that you would like for us to discuss? Put them in the message box. And that's the last question I'm going to ask you tonight. Put them in the message box. And okay, thank you. Now, great show, very informative. So, though, it sounds like we've been reaching people where they are, and we want to keep doing that. So that is good to know. Anybody? Because we ask this almost every week, and we just like to know, are there some topics? Because, me and Dope, we have our meetings every week, and we go over several topics. Oh, okay. Dope. We got some mortgage refinancing, ways to pay off debt. Okay. Okay. How about this? How to watch out for financial fraud and attempts. Um, oh, Mo Better says she wants to know more about savings. Okay. Okay. Gloria said the level of your presentation has been current, concise, helpful, and informative. I have truly learned a lot. Still learning. Love it. Dope. Another one coming in. Roth IRA versus a regular IRA, the differences. Another one from Joanne about mortgages, just in general, I guess. Okay, good, good, good. We'll keep that in mind. Make note of that, though. Some of these we have covered, and some of them we can go more in depth in. So thank you for your participation. Just wanted to get a feedback temperature of what's going on out there. So we really appreciate y'all being with us. So with that, Dope, let's go to the summary and takeaways of today's show. And I hope it's coming up. Yes, it is. So I'll take the first one. Dope. We talked a lot. Remember, our topic was coping with volatile times. The first one is understand your risk tolerance, especially in these times of, policy uncertainty, economic growth uncertainty, tariffs and taxes and everything. But at least understand your risk tolerance so you know which particular vehicle you need to be in that matches with your tolerance so you can sleep at night.
Yeah, and actually, we hope we beat this one to death, and that's to diversify. You don't want to have all your eggs in one basket. If things go good or if things go bad, they aren't going to affect any one particular asset class the same way. So make sure you're diversified between your assets, between your geography, and even within your assets, make sure you're diversified with different asset classes. And so try to spread your risk out. The more you're diversified, the better off you're going to be. And it's one thing to say, okay, I'm going to have all my money in AI related stocks. And that may indeed do well. But if you get an AI bubble, then you totally lose. So it's okay to have some money in AI, but maybe have some money in bonds, maybe have some money in a gold fund. You got to be diversified.
And stay on top of your things. I mean, there's so much information out there that we can have access to, like me and Dope, disclaimer, we get stuff from Kiplinger, Vanguard, Fidelity, Smart News. So stay on top of things. Don't just don't pay attention to your bank accounts and your portfolios. Not that you might not have to do things, but things happen and fraud be happening. So it's so important to stay current on. And I'm not saying you don't have to be no scholar, but at least stay current because there's so much availability and accessibility to information out there that can help you.
And I want to add to that, Bob. The cost of not knowing is very, very high. Very, very high. The cost of ignorance when it comes to how you handle your financial situation. Not knowing can be extremely costly, and we like to see you lower that cost. And finally, the final point we want to leave you with is to stick with your plan, and very important that you have a plan. And so we say stick with your plan, but if you don't have a plan, obviously you can't stick with your plan. So you have to have a plan of risk tolerance, all the things we've talked about. And once you set that up, it ain't set it and forget it, but it should stand through volatility. Okay, you won't make any panicked moves. You won't sell, and at the worst possible time. Stick to your plan.
That's a good one, though. And like you say, the bottom line is make sure you have a plan, and make sure you have a budget. I was told today about budget. It said don't use the word budget, Bob. Use spending plan, because when you say budget, you know what budget mean to people, though. Your money's on a diet. You gotta.
And plus, that's kind of an accounting term, and people tend to think that's kind of geekish, like you budget. But I like spending plan a whole lot better.
Yeah, he
You
said,
got to know where your money's going. You got to know where your money's going.
and that's what he said. He said you say budget. It's like your money is on a diet plan. Nobody likes that. I'm like, that's pretty cool. So with that, thank you all. It'll be our 218th show next week. I'm looking so forward to that. And gotta let you know, today's wonderful quote of the week comes from a deep contemplation of this one. And it goes like this. Don't ever take a fence down unless you know why it was up.
So,
We're glad you approve. All right, everybody. Thank you. Roll call. My sisters, all three made it on. We are family. I got all my sisters and me and Dope. Thank you all. Modestine, thank you for being there. Nolia, Gloria, Linda, we love you. Now, Dodie, love you. Mo Better, Joanne, Garnett, Nickens, thank you for being on. Rodney, L. Madison, Senior, TheNoteExperience.com. We got Kitty Cheney, the Toastmaster extraordinaire. Bonnie G. What's up, Bonnie? How you doing? Is that your
that's Big Sis.
Big Sis, right? She's be changing her name up on there sometime. Throw me off. What's up, Big Sis? And I think that covers everybody. Yes, no, I hope it didn't. Oh, Carl Chapman, my little brother. Love you much, my brother. Just had my 50th reunion at Woodrow Wilson High School, which was Stone Gas. And Joanne, that's everybody. I got covered everybody. Dope. Thank you all for participating in my little survey. And we look forward to seeing you, same bat channel, same bat place next week. Have a wonderful, wonderful week.
Peace.